And now we are going to meet the legendary investor, and we're going to move to New York. And in New York, we have with us a man who made history with a big bet against Lehman Brothers. The bank collapsed, financial crisis unfolded, and David Einhorn is still a very active investor, the founder and CEO of Greenlight Capital. David, can you hear us in New York?
I hear you great. Happy New Year to you.
Thank you, and Happy New Year. Any resolutions this year?
Yeah, we need to make at least double.
It's a good response here from our audience to that one. Quick look at the year ahead. What do you predict will happen that affects investors in 2025?
Oh my goodness, that is such a broad and open question, and I appreciate it. First of all, thank you for having me at the conference. I know I'm the last speaker, so I'm probably like the thing keeping everybody away from like smoked fish or something like that. In terms of predicting the future, Yogi Berra says that's like the hardest kind of prediction. So I'm kind of bereft from a lot of very specific predictions. I don't really know what's going to happen, and I don't think that it makes sense to try to really make a solid type of forecast, because then you kind of get anchored to that forecast and you spend your whole year evaluating whether whatever you thought on the first week of January turned out to be correct. I think if we look back briefly to last year, last year was filled with uncertainty, mostly relating to the elections. I mean, we spent most of the year waiting to figure out like who the next president of the United States is going to be. And now we have a president-elect, and he's going to take office in 2 weeks. And from what I can see, things are even more uncertain this year than they were last year, because you have no idea what this guy's going to do. I mean, we just watched an entire campaign, and you'd think maybe you knew what he was going to do. And here we are now in his period as he's planning. And all of a sudden it appears that the U.S. policy is focused on territorial expansion, which is an enormous surprise for anybody who was paying attention to the campaign. Now, that being said, just because it sounds like we're focused on territorial expansion, it doesn't mean that's actually, in fact, the policy. It doesn't mean that any of those things are likely to happen. The whole thing could be a distraction from something else that he intends to do, or he has no idea what he's going to intend to actually do, and we're just going to have to find out as we go. And so I think the thing to do from a forecasting perspective is just to recognize yet again, things are just massively uncertain, and it is very, very hard to figure out what's going to happen. But you can still have a few base beliefs. And I probably do have a few base beliefs that are inform the way that I'm going to construct the portfolio. And it's not necessarily a prediction as to like how the market is going to go this year. But from a big picture perspective, the market is about the most expensive that it's ever been in the history of the time that I have been managing the fund. And when I say the market, I really mean the U.S. market. I know there's other markets around the world that are cheaper. We are developed market investors, so we do invest in Europe and we do invest in the U.S. and a few other places. But the U.S. market is about the most expensive that we've ever seen. I think the risk premium is roughly zero versus government bonds, which is something that you don't usually see. You're not really being rewarded for taking equity risk. Now, that doesn't mean that 2025 is going to be a bear market or that things are going to collapse. But we go in with the view that the market is really, really expensive, which means to me that there'll probably be a better opportunity somewhere down the line for a bigger entry into equities. And so we're going to run a relatively low gross, and we're going to run a relatively low net, and we're going to try to make some money on individual ideas that we're able to identify in our research. And then we have a couple of macro views that we put on top of that. Like, I believe that inflation has bottomed again. I think it bottomed in August or September, something like that. I think we're on a policy and trajectory towards a re-acceleration of the inflation. I think we've already seen 2 or 3 months of data of that. I think that continues. So we continue to maintain a strong pro-inflation bias in the portfolio.
And you mentioned the uncertainty connected with what Donald Trump will do. And this time he's bringing with him, in a bromance, as we heard here, Elon Musk. And you've previously been critical of Musk's behavior. What is your view of Elon Musk now?
Well, I'm not going to be critical of Elon Musk today. Like that's not on my list of things to do. Elon is a super talented person. I think we may be lucky that he's applying his not just his intellect, but his influence on trying to actually get at the U.S. deficit situation, which has been one of the most intractable problems we have. I mean, I've recently, not very recently, but maybe a year or two or three ago, I would sit with like U.S. senators and stuff like this and say like, well, so what are we going to do about the deficit? And it wasn't a discussion, it was bipartisan. And the basic view is we'll deal with it when there's an actual crisis and we have absolutely no choice. Because it was bipartisan that we're not going to raise taxes sufficiently. We're not going to cut spending sufficiently. We're running a 7% deficit to GDP at a time of full employment, which is super unusual, to put it mildly, and probably a little bit scary, and suggests that at some point there's going to be a fiscal situation. So here you have Elon come in, and he fired 80% of the people at Twitter, and it still seems to work fine. And he thinks he's going to get after the deficit. Now, is he going to cut $2 trillion? I highly doubt it. But my guess is he'll make some progress. And this may be the best opportunity we've had to get at our structural deficit problem in a long time. So I'm rooting for him. I hope he succeeds and finds lots of great cost cuts and figures out how to get our fiscal house in order, because I do think it's a very, very serious problem that has previously been unaddressed. So this is as good an opportunity to get at that as I've seen.
David, I'd like to introduce to you now the Chief Investment Officer of Skagen, also a value investor. And please, Alexandra Morris, if you can come to the stage and have a seat. And let's start by going slightly back in time to Lehman Brothers.
Yes. Good morning, David. Oh, there you are. Good morning. I'd like to go back to actually 8 months before Lehman Brothers went bankrupt. You famously shorted Lehman at that time. What are your reflections and what key moments during that process stood out for you?
A few things came. First of all, I came at realizing that we had a problem in the financial system from a spot of one of the biggest investment errors that I'd made in my investment career, which was I was quite involved with a subprime mortgage company called New Century, which failed about a year and a half before Lehman. And it caused a big embarrassment and it caused a big loss. And it was nothing good to be said from that. But what I was able to do was take up the pieces and say, all right, so this happened here. What other things might be affected by this? And where else might there be these kind of problems? And so as I got into the months after the New Century had failed, I came to a view that, that the AAA bonds were not going to be safe, and that this was going to be a global phenomenon because people put money into AAA in order to be safe. Like this was supposed to be as risk-free as U.S. Treasuries, but you had AAA rated CDOs and CDO squareds and other mortgage things that were clearly going to have some loss content, and things below AAA were going to have a lot of loss content. This led me to short a wide variety of financial institutions and things that were sort of exposed to the AAA phenomenon. I only picked on Lehman in particular because of all of the biggest financial institutions, they seem to be the ones that had the biggest exposure and the greatest level of denial at the same time. In other words, lots of people had this exposure, but Lehman was publicly insisting that they had this hedged, that they had this figured out, that they had no exposure, and frankly, that they were going to be winners out of this whole situation. And not only that, they were going to take the opportunity of their lower stock price actually a higher stock price, to accelerate their share repurchase, accelerate their capital return, and double down on their investment in securities that were increasingly risky. That's essentially what the gist of why I came to choose them for more scrutiny, because you don't like to kick people a lot when they're down. I mean, when they're saying, hey, we have a really, really big problem here, like say Merrill Lynch was saying, you wouldn't want to say, hey, Merrill Lynch has a really, really big problem, because you're not really adding any information to the market. Like everybody already kind of understood that. So I picked on Lehman mostly because they were the biggest deniers of whatever their problem was when it was manifestly obvious that they had it. The other thing I will say in terms of a reflection on it, I got two more. One is that we just got exceedingly lucky. Like the Lehman outcome did not need to be the Lehman outcome. They had many chances to opportunities to save their company, to recapitalize, to avoid risk, to do the things that other people did, which would have led to losses, but not necessarily a complete failure and meltdown and blow up of the company, let alone the follow-on effects that came, from their failure. And the fact that it happened so fast, I almost view it as sort of like random. I've had other situations where I've looked at and said, wow, this situation is really, really terrible, and it can just drag on for years. And there's no reason why the markets couldn't have come back and, faster than they did. And Lehman could have, won by doubling down, and then it wouldn't have looked so smart. I think I got a relatively fortunate outcome, at least from the perspective of like that forecast and the way that I was looking at. And then the last takeaway I have from Lehman is the one that more affects me and the way that I've managed the funds similarly, which is that we did a really great job being short all of these financial institutions, but I did not do a very good job thinking about what this would do for the long part of my book, particularly in things like cyclical industrials, which also got annihilated. So we managed to somehow lose 18% in 2008. Now that didn't seem so terrible at the time because it felt like everybody else was down 35 or 40. But considering we really understood what was going on with the financial situation, it was kind of a disgusting result. And it has influenced the way that I've been trying to manage the portfolio ever since.
You are both value investors and known as that. And value as a concept, what does it mean, Alexandra?
Well, I think one thing is that the market believes that it's pharma French value factor, just buy price book at a very low price to book. But value is always very interesting to discuss what you understand by value. And I'm really interested in hearing how you interpret value, David, and learn something new.
Sure. I believe that value means buying something for less than it's worth. You're buying it at a discount. It doesn't mean, and things that grow rapidly are worth more, but you want to buy it for less than it's worth. And we look at it on a sort of a traditional basis. Something is worth something that has to do with the asset values and the future cash flows of the company. So we want to buy things for less than they're worth. It doesn't mean that I don't view growth as the opposite of value. I view growth as a component of value.
And then we have one of our viewers, one of our other participants in the conference, sending in a question saying that the topic today has been uncertainty. And is there anything, David, that we can be certain about when it comes to investments?
We can be certain about? I don't know. I mean, we have a market holiday today. I mean, that is spectacular. I can be talking to you and not being worrying about like what's happening in the market this morning around the open. I'm reasonably certain the market will reopen tomorrow. So, you can come up with things that are sort of pithy like that and say that there's like a lot of certainty about it. But in terms of like what's going to happen macroeconomically, what's going to happen that's relevant for investments aren't about certainty. Investments are about probability and about risk-adjusted opportunity. And I don't believe that we have any certain investments. There's not one investment I can name in my portfolio that I know is going to do great this year. If I knew that, we should just put like all of our money into that. But the reason we maintain a somewhat diversified portfolio is there are no sure things. And so you have to figure out like, well, what's the most you're willing to put into your best idea, recognizing that even your best idea has a wide range of possible outcomes.
Alexandra.
David, we've now just discussed one of your most known successes. Could you maybe describe one of your biggest mistakes? We all make mistakes, and I think the key thing is to learn from them. So can you describe one of your big mistakes and tell us what you've learned or changed in your process from that?
The two biggest long investments that have blown up over our time, the first one I referred to before was the New Century, where I did make a mistake. We owned a company. We liked the company. The company changed its business strategy. And rather than say, I don't like this anymore and I'm going to sell, I said, I know better than you and I'm going to fix this. And so I went on to the board of directors to try to get the company to undo a decision that I thought didn't make any sense. And you might notice that was in 2005 or 2006 when I went on the board. And I haven't tried to put myself on any boards ever since. And I've certainly come to the view that if we're so unhappy with what a company is doing, that we really feel like it needs to be fixed to that extent, we're way better off to sell than to try to fix it. The second huge mistake we made was we invested in a fraud that was called Sun Edison. And there maybe the initial underwriting was right, but there were lots and lots of signals that there was fraud. And I kept telling the analyst to go back and check on it. And he kept coming back to me and saying it was fine. And I really, really wanted it to be fine. For a while, it was the only thing that was working in our portfolio. It was a growthy, exciting kind of thing. But there were just tons and tons of red flags. And I would say we very blindly and almost willfully ignored them. And it turned out truly to blow up spectacularly in our face. And frankly, I should have known better because I know how to find these flags for stuff, and they were all over the place. And so it was a tragic investment error.
Can you share some thoughts on how to avoid value traps? And maybe as a follow-up, what is your comment to those who claim that we are now witnessing one of the largest growth traps in history?
All right. Well, a value trap is a value stock that just didn't go up, and you know about it after the fact. But honestly, you can actually break it into a separate characterization. If the situation is deteriorating and it appears to be inexpensive, you have to figure out why the deterioration is going to inflect and improve. And if it's not going to inflect and improve and it's going to continue to deteriorate, you need to have a very, very high rate of embedded return in order to justify a deteriorating situation, even when it seems like it's at a low multiple. And if you add financial leverage to the situation, you're taking probably too much risk to even engage in the first place. You know, I think that value traps is something that is very, very prevalent, and I think it's something that is very likely to continue. The way we are addressing it is we are focusing on companies that are returning double-digit amounts of capital to shareholders on an annual basis. So between a buyback and a dividend, we're looking for double-digit cash-on-cash returns, which still doesn't mean the stocks can't go down, and it doesn't mean that we're going to have a great result, but it means we're primarily relying on the companies to pay us the money as opposed to other investors to re-rate the shares. Now, if the other investors re-rate the shares, that's a bonus, particularly if it's to the positive side, but that's not our base expectation. Finally, relating to your question about a growth trap, is the first time I've really ever heard the phrase really used. I don't know that we're in what you would call a growth trap. I see the situation as very problematic. I view the stock market to be extremely expensive. At some point, I expect it to become less and perhaps a lot less expensive. But frankly, if it goes down, I think everything will wind up going down. I don't think it'll just be the more expensive stocks. Hopefully, they'll go down more than the less expensive stocks. I view what's going on right now as part of the market structure being fundamentally broken, where it's passive flows, and other people who are investing money mostly don't care about the value of what they're paying, what they're buying. Like they have an opinion about price, but they don't have an opinion about value. And so things become untethered from their actual value. And that creates a fundamentally risky situation. I don't have a problem with people who like to play roulette or slot machines or blackjack or stuff like that. But I think when you're buying stuff for way more than it's obviously worth, you're kind of taking a punt like that. And it's been working out really great. And and sometimes you do really great when you play casino games too. And this can go on for some time. I'm not predicting some imminent demise to these things, but these companies many of them are trading for far more than they can conceivably be worth. And it does seem that over some probably long period of time, or maybe much sooner than everybody expects, things eventually tend to revert toward value.
You touched on casino games, but we also know you are a very accomplished poker player, David. And just to bring us into this element that I know Alexandra is keen on asking you some questions about, what makes a good poker player? What is your secret?
Poker is not a casino game. Poker is a game of skill. And, there's an uncertainty, there's a variance. Not all that different from investing, where there's an uncertainty and there's a variance, but it's very probabilistic, and it's also very psychological, because you're playing not just the cards in front of you, the things you can see, and not just the probabilities of cards that may yet come, but you're also playing tactically against other players and getting into their psyches and understanding what their strategies are and trying to counter against it. I think my own strength as a poker player is not that dissimilar from my strength as an investor. I'm pretty decent with some of these basic kind of things. And I also have just an enormous amount of resilience and equanimity, so that when things don't go my way for a while, I don't get terribly frustrated. I don't start doubling down. I don't start doing crazy things, and I'm able to be kind of resilient and say, all right, well, now what do I do? Maybe the last few hands didn't go my way. How am I gonna work from here?
Yeah, I think that's actually one of the key things with good professional poker players, that they're actually folding much more often than amateur poker players, who only fold less than 50% of the time, whereas professionals fold over 80% of the time. So what is transferable from poker playing into your investment processes, if any?
I've thought about this a lot, and I don't think it transfers. I think the investing transfers to the poker, but I don't think that the poker transfers to the investing. I think they're cousin skill sets, but poker players, they sit down with a certain number of chips, and you kind of begin fresh with every session. And with the investing, you come in, and our portfolio today is going to look an awful lot like our portfolio from yesterday or from last week. And you don't really start fresh. It's more of a continuous game. And, poker players, sometimes they're just going to go bust, or they're going to lose all of their chips. And when you're investing, you really don't ever want to do that. Like, you don't want ruin. In fact, you don't want to go anywhere near, that kind of a risk profile or drawdown. And so, I think poker is something I play when I'm ready to accept a bit more variance. But I don't think people who are happy accepting lots of variance, which is most poker players, are very as well suited to be investors.
That's fair enough.
We have a lot of questions coming in from our participants, David, and one asks, what is the most underappreciated risks you see in the market now?
Underappreciated risks in the market, I think, has to do with the breakdown in the market structure. I think most people do not recognize how prevalent the breakdown in the market structure is, how so little capital is actually being allocated on the basis of, just to back it up a little bit, let me just elaborate on what I mean by this breakdown of structure. If the idea of markets is to allocate capital, and the idea of investing is, to buy undervalued things that are worth more, not a view of price, but actual undervaluation, so that your investment is actually contributing to market efficiency. You're helping create finding pricing to the equilibrium, amount, or at least you're doing your best you can to try to take advantage of opportunities that all point in that direction. When I go back in my career, 20 years ago, The big money, the important money, the money that was driving the market was a bunch of people sitting at long-only institutions saying, I think this stock is worth 30% more than where it's trading today. And that didn't mean it was a value stock. It could have been whatever the most exciting growth stock. It could have been Coca-Cola, which was the leading stock in the 1990s or something like that. They think it's worth 30% more than where it is. They're going to buy it. They're going to sit on it for some number of years. If it takes 10 years to be right, they make the S&P plus 2. If it takes them 5 years to be right, they make the S&P plus 5. And if it takes 2 years to be right, they make the S&P plus 14. Any of those results are great. And they want to put a portfolio together that looks a lot like those kind of numbers. And new money is going to come in every day, and they're going to be able to find new opportunities to buy things that they think are undervalued for whatever the reason is. That investor has been fired. That person does not exist. There is no committees that are doing these things. It is a tiny portion of the actual trading volume, and it has very little to do with the price discovery. The price discovery today has to do with index funds, which are passively buying everything based on what they were previously worth, which aren't thinking about things. It is algorithmic trading, which is basically trying to anticipate everybody else's orders. It is people who have very short-term opinion about price. And I don't mean the price 6 months from now. I mean the price, when my options expire this Friday. And then it is maybe what we'll call these pod shops and stuff like that, which have some level of fundamentals, but they basically care about what's the next 1 or 2 things that are going to happen. Am I going to be right this week? Am I going to be right next week? Am I going to be right when they announce the quarter? So on and so forth. These people are not interested in what the value is. They're interested in what the price is. And so the result is that the vast majority of trading volume has nothing to do with converging towards value, which means that we now have what I consider to be broken markets. Overvalued can become more overvalued, undervalued becomes more undervalued, and you're not having capital efficiency in the way that the markets are designed to create. And this creates what I call a very, very stable disequilibrium. Like this can persist as long as it persists, but fundamentally it's a disequilibrium. And I don't know if or when this will ever revert, but if it ever does, there's going to be a ton of carnage that will come from that.
So given to what you're just saying now, does this actually spell the end of the traditional buy and hold value investing style, or do you see any opportunities?
Oh, it's gone. From a professional community, it's gone. These people have been fired, and they're not coming back. These large, long-only complexes used to have analysts on every call. They used to have 5 people in every meeting. They used to have enormous research staffs. They needed to know everything that was going on at every company. And now, vast majorities of their money has been transferred to index, which pays, 6 basis points or something like that. And what's left over for active has been cut from a percent fee to 40 basis points or 35 basis points. So they're running, half the assets at 1/3 to 40% of the fees. They have fired the people that used to be doing all of this work. It doesn't mean they're not following any companies, but they're certainly not following every company. And they're terrified. And these businesses are gone, and these professionals are there. Now, I think that creates a real opportunity for those that remain. It's a much less competitive business that you're going to find much greater levels of misvaluation. But on the other side of that is you're fighting a continued secular trend of firing these people, taking their money, making them redeem the value stocks that they already have, and having it redeployed into the market cap weighted indices. And we certainly saw that prevalent yet again in 2024. I think that's a lot of what happened in the late part of the year. You could almost feel the flows coming out of active management at the end of the year and being redeployed in the indices as you saw the enormous divergence between the mega cap stocks in the United States and pretty much everything else, which was collapsing. It just felt like it was like year-end redemptions from active managers. This is an ongoing phenomenon, and it's something that is a headwind for people who are trying to buy undervalued things and not just buying things based on, hey, it has a big weighting in the S&P, so that's the weighting that I need to have.
We have with us also an audience in Stockholm, David, and I'd like to introduce Skagen's Andreas Buön, who is there with his colleague Jonas to come up with some questions for you.
Great.
Hi, David. Even though the market is closed, I know you have a very busy day ahead, so we'll try and keep it short, Jonas, won't we?
Absolutely.
So the other bold man standing next to me here is Jonas Edholm, who is the lead manager of Skagen Focus, our global small and mid-cap value fund. So I think you have a question for David.
Yeah, thank you, Andreas. And indeed, a great pleasure to be standing here and have the opportunity to ask you a few questions, David, here from Stockholm. And I'd like to go back to the concept of value, since we are value investors both, I believe. So my question would be, and you refer to your ways how you value stocks and so on, but in general, how do you treat higher or even aggressive growth expectations in different investment cases, making stocks look perhaps optically cheap in your sort of valuation analysis as a value investor?
Not sure I fully grasped the question about growth stocks. What I would say is that forecasts are difficult, and the more distant the forecast, the more difficult it is, the more variance there is around it. And companies that have tons and tons of growth forecasted for long periods of time are particularly susceptible to disappointment and change in those kind of forecasts if you're paying a value that reflects multi-year optimism. It doesn't mean the multi-year optimism never materializes. Sometimes it does, but you have to be, I think, careful, because if it turns out not to be there, and you've paid a big price for the opportunity to participate in that kind of a growth, you can get hurt pretty good.
I wanted to ask you quickly, David, on the subject of intuition, or investment intuition. And is this something that you actively seek advice from when you do your analysis, or is this something that you try to fight back on, to not interfere with your critical thinking?
I'm sorry, what was the word? Investment what?
Intuition, your intuition as an investor.
Oh, intuition.
On to not interfere with
I think
your
intuition.
analysis,
I think intuition is important. I view this as a puzzle-solving exercise, and I think that it's not a quantitative exercise. It is not a question of screening and figuring out, well, which are the things that the math just says. We've always tried to have a more practical view of, well, what are the other market participants doing? Why is this opportunity existing? What is misunderstood about it? What are the motivations of the various players, be they the management, the other market participants, and so forth? And I think a lot of that intuition and experience that relates to the intuition is a chunk. You start with basic maxims, like people tend to try to do whatever they've been incentivized to do. So you have to figure out, well, what are they incentivized to do? And if they do that, what's going to happen? And are they likely to succeed? When you have people with bad motivations, they often do, and bad incentives, they often do bad things. If you've got good motivations and good incentives, they often do good things. And I think that is more a question of intuition than things that you're going to be able to make out of an Excel model.
Thank you. And one more question, I guess most in the audience are wondering, of course, where you find value today in today's very polarized global equity markets. In what areas, what comes up on your radar as undervalued, misunderstood, ignored, and so on, looking out 2 to 3 years?
All right. Well, I'll give a very general answer, and then I'll give a little bit of specific answer. The result of the decimation of the active management means that every year a bunch of these stocks get sold. Active managers tend to try to buy undervalued things, and then as they are redeemed, then they're forced to sell undervalued things, and undervalued things become more undervalued. And this has been going on now for some time. And you actually got to the point where there's a lot of things that are so undervalued that you don't have to pay what you used to have to pay. So we used to be perfectly happy to pay 10 or 11 times PE for some company that we thought would do 10 or 15% better. And if we were right, maybe we'd get a 13 PE on the 15% better and make 50% over a couple of years. And that just doesn't seem to be the case. But you don't have to pay 11 times earnings for that anymore. Now you can pay 5 times earnings or 6 times earnings. And particularly when you look at companies, maybe market caps between 1 and 5 billion in the US, there's actually a fairly large number of companies that have been completely discarded. There's nobody from these long-only funds following them anymore. And you're actually able to get a cash-on-cash return from the company, in terms of buybacks and dividends and stuff like that is adequate to compensate for, all of the difficulties in the market structure. I'll give one theme though that I think is also possibly true, just in terms of a forecast. I do believe that with the change in the administration here in the United States, the war in Ukraine is likely to come to an end relatively soon. I genuinely think that is likely to happen. And I think we should have a pretty good opportunity in some of these European cyclical companies that have been really, really left for dead over the last few years. And so we're finding things in Europe and that are really, really inexpensive, I think decently positioned for even a modest recovery, where we're actually also getting the nice cash returns. So I think that if I had to pick an area that's going to surprise in the near to intermediate term, I think European industrial cyclicals, with the exception of European autos, which, as was mentioned by Luis, are under real strain from the competition from the Chinese.
Many thanks to you in Stockholm for your questions, and I'd like to bring in some questions from the audience here at large. And one very concrete one, David, to you is, what's your top stock pick for 2025, long and short side?
Well, let me start with the short to make it easy. About 4 or 5 years ago, we stopped talking about individual short positions. And I think that served us really well. And I'm not going to make an exception here. So we're not going to talk about an individual short position. In terms of the long, I will talk my book, obviously. I'm the chairman of a home builder, Green Brick Partners. We build in Dallas and Atlanta and to a lesser extent, Florida. These are secularly growing markets. I'm the chairman. The CEO is the best business partner that I've ever been involved with. Is extraordinarily disciplined. He has a terrific execution. I think we have a terrific business plan. The stock is trading about 7 or 8 times the current earnings. We have an unlevered balance sheet, and we're deploying and returning on capital, 25% after tax, and it's and we've been doing it for a long time. And the idea that something like this is still trading at a mid to high single-digit PE multiple with these kinds of returns and this kind of growth prospect, I think it's really undervalued. I think the company is positioned to do very well. And I would call that my favorite idea for 2025.
Another question. Warren Buffett is now piling up cash. How do you interpret that?
Warren Buffett is underrated over a very long period of time as a market timer. I think there are a lot of people who've picked stocks really, really well for a long period of time. But what I think has distinguished him, and people do not give him credit, is not in the, hey, how is the market going to perform today? And I'm going to change my forecast 3 weeks from now and then change it again in 3 months. But in terms of very big picture, Warren Buffett has been a generational talent as a market timer. He managed to basically sit out the bear market in the early 1970s. He managed to get out of everything that was liquid before 1987. He did the same thing with the internet bubble. He's done the same thing in certain fixed income. When 2008 came along, he was the guy with all of the money to bail out all kinds of things and take advantage of the opportunities that came to people who had money when nobody else had any money, or very few people had money. And I think that being able to buy and those kinds of opportunities are the things that have separated him from many other peers or semi-peers. He really doesn't have any peers, but the reason why he's, besides living as long as he's lived into his 90s and functionally well, which is something we can all aspire to want to do, is his big picture market timing has been amazing. And you see him selling Apple and other things like this. Apple, we owned Apple. It's the most profitable investment in the history of Greenlight. We owned it for about 5 or 6 years. It generally traded around 9 times earnings. It was generally growing about 20% a year while we owned it. And now it's at like 40 times earnings, and it's growing less than nominal GDP. And Warren Buffett is selling it because he's raising huge amounts of cash. What he's going to do with it, he probably doesn't know. But if there's a better opportunity set to buy things, he's going to have a lot of cash to buy when that opportunity set comes along. And based on his long-term history, I think this is something to pay attention to.
Alexandra, looking at 2025, the outlook.
Yeah, well, first I would just like to say that we share many of your optimism about the pockets of opportunities in the market today. But I would just like to ask a question on crypto. And how do you see crypto as a viable long-term investment? Or do they conflict with your fundamental value approach?
Yeah, I think I've been trying to think a lot about crypto. And I do think we're going to have digital currencies. I suspect paper money eventually will go away. I don't mean fiat money. I mean literally the paper bills in your wallet. You can already pay for most things off of your phone in any case. And I think it's a matter of time before the government digitize most of the money. It may be called central bank digital currencies or whatnot. I think that's the direction to headed towards. The question is what about these private cryptocurrencies? And I look at it and say, well, they're not really money. They're not really part of the reserve system. They're too volatile really to be transactional for the most part. You can't really buy something where the price might change 15% by the end of the day. Like that doesn't really work too well. And so I've come to the view that I think crypto are like collectibles. I think it's like art or baseball cards or stuff like that. And they have value, and they have value because people decide that they have value. Like you could look at a Picasso that might be worth, I don't know, $100 million or something like that. Or you can say it's a canvas with some paint on it that, it looks like, my 6-year-old could make, in which case it's worth like, what's the canvas plus the paint worth? $10 or something like that. But everybody agrees that these Picassos are worth $100 million, and so they are. And so if everybody wants to agree that Fartcoin is worth $1.5 billion, well, then it's worth $1.5 billion. And if you want to trade that. God bless you. Like I have nothing against people who want to punt and stuff like that. And if that's something that you enjoy and you want to spend your time on, or you think you can make money, trading against other market participants in a great big trading game, God bless you. Like I have no problem with it. I don't think it's really appropriate for what we're trying to do, which is to buy things that are fundamentally undervalued and misunderstood. There's plenty of things that one could trade or hang on to. And many of them will go up, and we're not going to participate in every trading opportunity that exists.
Well, thank you. That was a very clear answer, David.
And many thanks, David, for taking part in the conference and being a guest here at the New Year's conference. Many thanks to you, Alexandra Morris, for having this conversation, and all the best for 2025.
Great. I'm delighted to be here.